So good morning. I think we're going to go ahead and get started. I'm going to just do a brief welcome in Spanish. Buenos días a todos, bienvenidos. El webinario se va a realizar en español, en inglés, pero si gusten pueden tener una interpretación simultánea. Solo tienen que hacer clic en el globo donde dice interpretación. Esperamos que disfruten del webinario. So good morning, everyone. I was just announcing that there is simultaneous translation into Spanish. We're going to be having the webinar in English, so we're going to get started now. And welcome to everyone. This is the monthly webinar series offered by Foodman CPAs and Advisors. And we're joined as usual by our CEO, Stanley Foodman. Welcome, Stanley.
Good morning. Good morning. Buenos días.
So today's talk is the title of our chat today is a little bit dense, but we're going to try and make it interesting. Integrating tax compliance into corporate governance. And one of the reasons we wanted to come up with this is that we found as we talk to some of our customers and as we look at compliance programs, tax compliance of FATCA and CRS, and what we're talking about today is going to be primarily FATCA, but the same applies for CRS. We found that the compliance program for tax compliance tends to be separate from AML and OFAC and some of the other international regulatory compliance programs. And I think it has two effects. First, it duplicates efforts that may not necessarily need to be duplicated, but it also means that oftentimes tax compliance doesn't get the attention that it needs. So we want to talk a little bit about how the regulations are evolving and how compliance standards are evolving, but also some of the steps that you can take as a financial institution to ensure that you're giving the proper and appropriate attention to your tax compliance. So we're going to start out by talking about some of the evolving regulations at both the national and international level. And Stanley, one of the interesting things is despite some of the tax cuts that we've seen, and despite the fact that there's not tax cuts, budget reductions, and despite the fact that we're seeing some reduction in personnel, the IRS is still robustly conducting investigations and expanding its presence.
Well, it's trying to. It's running into a somewhat of a roadblock, if you will. The IRS received a 10-year budget that was the highest that I can remember in my lifetime, and it was something like $80 billion. And that's been reduced by successive Congresses, and now it's around half of that. And now they're running into an issue with being able to service its customers, which are the taxpayers of the United States, because the current administration just forced these agencies to fire their probationary employees who were doing a lot of the more mundane things every day that allowed the rest of the agency to function. So they're having personnel problems, but they've had those for years. So what they've done is they've tried to use IT to fill these gaps as much as possible, and they're moving over to artificial intelligence to do so. They're moving very rapidly in that direction. We've talked about the IRS criminal investigation extending its international footprint. It's launched attaché posts in Nassau in the Bahamas and a cyber attaché post in Singapore. They've had them for years in Bogota, Colombia, and in Panama City, Panama. They've had one in Haiti for some time, and they're starting to put them in other parts of the world. But the other thing that's interesting, which we haven't really discussed, is how the Anti-Money Laundering Act of 2020 is having an effect on all of this, because it is. The United States is an outlier in the sense that it does not consider tax crimes or tax evasion to be a predicate offense or a specified unlawful activity for purposes of money laundering charges or money laundering crimes. It's specifically exempted because of the complexity of the Internal Revenue Code. That said, the IRS has been actively using the way in which laws are constructed in other countries to do investigations regarding its own citizens who are in those countries. So I know of a case personally where, because we were involved with it, where they wanted to investigate a U.S. taxpayer living in Panama. In this case, could have been any other country. It happened to be Panama. And so they made the investigation through the authorities in Panama, the competent authorities, where they now treat tax evasion as a predicate to money laundering. And so the company got a subpoena, effectively, a requirement for them to give up all of their information regarding this taxpayer and the activities of the company to the anti-money laundering authorities of the country of Panama, who then in turn transferred all that information to the IRS, and it turned out that they weren't committing tax evasion, as I knew they weren't. But the point is, it was used that way. And the AMLA, the Anti-Money Laundering Law of 2020, and the new Corporate Transparency Act, and all these things are what are called long arm statutes. And it's essentially a way of saying two things. Number one, if you're U.S. or you have U.S. ties of some kind that we can attach to you, we, the government of the United States, are going to follow you everywhere in the world if we think you've committed a crime. But the second part of it, which I think is very important, is, and we don't care what local law says, because we're going to punish local law or the local law enforcement people or the governments locally who don't feel like cooperating with us because local law says they cannot. And that's the direction it's going. And it's been going there with greater and greater frequency and more force. So the IRS has internationally come up with the J5, the Joint Chiefs of Global Tax Enforcement, that are ostensibly committed to combating transnational tax crime to increase enforcement. Of course, transactional tax crimes tend to be associated with other crimes. And so it's a much broader concept than what people think it is. And it goes into directions that folks who are thinking tax don't really understand or aren't conscious of. Okay, so and the other thing that's affecting this is something known as the BRICS nations, and we don't know what's happening with that, but there's an.
Can you talk about, just define what you mean by the BRICS nations?
So Brazil, Russia, China,
India,
India, Indonesia, a number of countries have formed this group called BRICS, and BRICS is designed to try to diminish the impact of the US dollar on the world economy by trying to create a substitute set of currencies by which the values of goods and services can be quoted and not get involved with the US dollar. Because being involved with the US dollar creates many or provides the US government many excuses for imposing its will in ways that is not popular in other countries. So right now, our J5 is the Australian Tax Office, which has been very active, by the way, in tracking tax evasion, and has helped create, and was very to use a superlative. It was very instrumental in creating the concept of transfer pricing crimes, which is called in the international
BEPS.
parlance.
It's BEPS, right? Base erosion profit.
Yeah, yes, exactly. BEPS, base erosion profits. That is, it's to erase profits locally where taxes were higher and moving those profits somewhere else without any actual legitimate economic reason. And all of these companies are involved in data sharing and have been for years. What they're doing is they're providing each other with more and more tools. And they exchange information, they share data, they collaborate, and they're building capabilities to combat cybercrime and virtual currency abuses or virtual asset abuses, blockchain abuses, which is interesting because blockchain is a great weapon for them, because the distributed ledger can't be erased or modified. And then there's the issues that go on with the dark web, which also is tied to the blockchain and virtual currency and so on. And so, we know the coordinating enforcement related to crypto, professional enablers, CPAs, like we're not enablers, but CPAs, my firm isn't an enabler, CPAs and attorneys, and other sorts of trust companies which have professionals installed in them or involved with them, and platforms of different kinds. And so there's been a lot of case studies. There's been a number of case studies, but some very big ones, however, and that are getting bigger. You can talk about Binance in a
Okay.
short while, but right now we're talking about the fact that you asked the question about how active the IRS is. So in fiscal year 2024, IRS, which ends in September 30th of each year, so as of ending September 30th, 2024, the IRS Criminal Investigations Division initiated more than 2,667 criminal investigations that resulted in trials, and they had a 90% conviction rate. And because of that, they were able to identify $9.1 billion in fraud from tax and financial crimes. They obtained court orders totaling $1.7 billion in restitution to the IRS to help them pay for the cost of doing these investigations and to provide them with more money, of course, because it's always the search for more money that's involved. And they seized criminally derived assets totaling about $1.2 billion. The U.S. saw its first indictment and guilty plea of a U.S. taxpayer only and solely for not paying taxes on gains from cryptocurrency transactions or sales of cryptocurrency. I don't know that it was only the sale of cryptocurrency. It could have also been for the purchase of cryptocurrency, depending on the asset that was exchanged and its value and its
Well, it
relative.
was the underreporting of gains, right? I mean,
It's all
people
about
need
the
to understand.
underreporting
Yeah.
of gains. And just as a quick insertion into all of this, cryptocurrency can produce reportable transactions involving gains, which relate not only to the sale of cryptocurrencies, but also the purchase of cryptocurrencies. And these are capital gains I'm speaking of right now. We call long or short-term capital gains, ganancias de capital, based upon the value at which they acquired it and the value which they received when they disposed of it. But in addition, we also in the United States, because we treat it as an asset rather than a currency or a divisa, because it's not emitted by the U.S. government, it's not official. So that if I use cryptocurrency to purchase an automobile, for example, well, for the automobile dealer that sold me the crypto, they now have ordinary income from the receipt of it, which is taxed at a higher rate, as opposed to a capital gains transaction. So it's very interesting. It's more complex than people understand. We've been doing a lot of consulting about it for businesses, and it's becoming it is now a major target for the IRS, and not only the IRS but for governments around the world. The U.S. Department of Justice announced that a gentleman named Frank Richard Algren III, and maybe there's a family history of these things, I don't know, he's number 3, was sentenced to 2 years in prison for filing a tax return and underreporting gains from selling 3.7 million in Bitcoin. That's just the tip of the iceberg as to what's been happening. Since 2014, the IRS has been telling the U.S. public and announcing it in various ways that they were going to be focusing on this, and they are now. And from that, let me segue with you into Binance.
So Binance is not technically a tax case, but I think it's really important for people to understand what was going on here, because Binance was the world's largest virtual currency exchange. They were not based in the US, but they were the target of US regulators. And even though the IRS didn't specifically target them, the IRS criminal investigations contributed to the entire investigation. And what happened with Binance was that all of the US regulators, the OFAC, the SEC, FinCEN, all got together and basically went after this entity for engaging in, well, initially it was an OFAC case because they were engaging in the exportation of goods and services to sanctioned individuals. In other words, financial services, you can't export them either. It doesn't have to be just physical goods. And according to the indictment, the Binance executed nearly 1.7 million virtual currency trades. That's number of trades worth about $706 million on its platform. And this was conducted between U.S. persons and other users in sanctioned jurisdictions. But after OFAC got its hands on Binance, then the SEC stepped in as well. And so they're now subject to an SEC investigation. and the CFTC is fined both Binance and the former
And
CEO.
who is the CFTC?
Oh, the Commodities Futures Trading Commission. Sorry.
Yeah, no, that's okay because these are some of the agencies that are being impacted by our current administration in the United States.
Correct. Correct. And I guess the irony of it all is that the IRS actually makes money for the government by recouping taxes that haven't been paid. So it would
It
theoretically
is
help.
ironic, yes.
Yeah. But the key takeaways from Binance is that the US regulators are targeting cryptocurrency exchanges and the financial institutions that service the cryptocurrency market. And they are all working together under the direction of the Department of Justice. And the financial institutions that act as cryptocurrency exchanges or offer services to them must ensure that they have compliance. And obviously, that includes the ability to track cryptocurrency relative with respect to its tax impact that may affect U.S. persons, and U.S. persons who think they might be safe buying cryptocurrency in a foreign jurisdiction need to understand that that's not going to be the case going forward.
Well, it's not the case because the IRS has developed algorithms to follow these things through the distributed ledger, and because they were never fully anonymous, they were only pseudo-anonymous, and people bought into the romance, if you will, of being pseudo-anonymous, I guess, and it's resulted in what are called John Doe summonses to many companies, which have either direct presence in the U.S. or not a direct presence, but rather they're coming across the board into our country with respect to the internet and wire information and electronically. And the IRS uses a weapon called, and not only the IRS, the other regulatory agencies called John Doe summonses, in which they say to the courts, we need to subpoena this company for its records because we have a reason to believe, and they have to produce in evidence for this belief that's satisfactory to the court, that there are things happening which are violations of our laws, and we want to investigate those things. And we don't know exactly who we're targeting yet, but we have a profile of who we're targeting. And that profile could be a profile of thousands of people. And so these subpoenas are issued, these summonses. Summons in IRS terminology is the same as a subpoena for other situations. They're issued, and these companies are forced to respond, and they can comply. They can directly comply. They can push back. They can get reductions in the numbers of documents or the parameters. But eventually, they all have to comply, and that's part of where they've been getting all of this information from.
But it's also taking place on an international scale because
Yes.
the CJ5 countries are participating together to try and
Yes.
tackle offshore tax evasion.
Yes, and they are using our anti-money laundering laws to do this. Because remember, in most of these countries, which are CRS compliant and financial action or GAFI compliant, financial action task force or GAFI compliant, remember that among those recommendations from the Financial Action Task Force is that tax evasion be a specified money laundering offense or a specified unlawful activity. And so they know what our laws are, and they're using the help of the United States to get information that they want internationally, and they're helping the United States to get it by using other laws. And this is what's happening all over the place. When I say all over the place, I mean that literally. So because of this, all of this good stuff that's going on, we come down to the famous GIN, okay? And what's the famous GIN? The Global International Identification Number, right? And what is the purpose of it? The purpose of it is to deputize, is the result of deputizing foreign financial institutions and through Model 1 agreements, actually entire countries, to help the U.S. to locate the U.S. taxpayers that are not properly reporting or that are not properly paying their taxes. And it's a complicated system of reporting, by the way, very complex.
Interesting that as an aside, it just occurred to me that we've noticed, one of the things we wanted to talk about is what we at Foodman have seen in some of our clients
Yeah.
in different countries. And even though the regulations for non-participating countries, in other words, countries that don't have an EGA, even though those regulations are more onerous, to a certain extent, the compliance obligations in an EGA country are higher because the local tax authorities are closely monitoring what's being done. So we've seen in a number of countries where the local tax authorities are applying monetary sanctions, are issuing orders of violation, even if they don't have a monetary sanction attached. Whereas in terms of the IRS, really, to lose your gin, you kind of have to take your eye off the ball completely. The people
Well,
who've
yeah,
lost
but what you
gin,
said is really important because when they get dinged, if like we like to say here, when they get punished by their local monetary authority, whoever it is, by their local authority, that can constitute a failing that can result in the loss of a gin, or at least the suspension or other punishment by the IRS. Because
right?
they have to report on it. When that happens, they're required to tell the government of the United States, hey, our local authority didn't like what we did and they punished us.
So what we've seen mostly in terms of the entities that have lost their gin, I don't know of anyone in an EGA one country that's lost their gin solely for a compliance failure, if you will. But what we've seen is in non-EGA countries, almost every one of the companies that are banks that have lost their gin has been because they did not present their certifications of compliance. And that's an important point that you still have to present those every 3 years. Keep your eye on your
Which
portal.
which is all about the concept of being pedantic and being bureaucratic. The wheels of the bureaucracy can cause a bank to lose its gin simply because someone didn't report, and it can become automatic as a result. They may get warnings, they may get requests, but ultimately somebody flips a switch, an electronic switch, and the gin and the portal closes. They can't get in. Or
Correct.
they're pulled off of the gin list, which means that they're now can be subjected to other sanctions by other banks, not governments, banks, because the other banks
Correct.
won't want to do business with them, and they don't, as a practical matter, do business with banks that don't have gins, and
Because they themselves can get fined if they're
and
not
because on
reporting
their side
appropriately.
they can get fined. That's right.
Exactly. So just
And
before we move into that withholding, because I know you have some good examples there of that, but I also just wanted to mention there's two other ways that we've seen institutions
okay,
lose their gin. One of them is if the gin was revoked for OFAC reasons. So when a lot of Russian banks were recently sanctioned by OFAC, the IRS stepped in and canceled their gins. So
why? Let's tell the audience why. The IRS, OFAC is part of what department of the U.S. government?
Treasury, as is OFAC.
And as is OFAC. Both are part of the Treasury Department, and where the IRS is not supposed to share, under most circumstances, certain sensitive information. In fact, if anybody remembers the movie The Wizard of Oz, if they ever saw it, you had the wizard behind the curtain, and then he said, "Don't look behind the curtain, look over to your left, because I don't want you to look behind the curtain, because if you look behind the curtain, you'll find out that I'm here and that I'm not a mighty wizard." But at the end of the day, that's what they're telling folks. Don't look behind the curtain. So what goes on behind the curtain is that these agencies all cooperate. And it's not for the benefit necessarily of its customers, in this case, which are the banks.
Correct. And the third reason that we've seen some gins revoked is for entities that are registered as FFIs. If they registered a second time to become a sponsoring entity with the little SP in their gin number, if they never took on a sponsored fund, if they never ended up sponsoring anything, the IRS did go in and revoke some of the SP gins that the sponsoring gins that never were used properly. But for most part, that's not a major issue for the financial institutions if they're not going to sponsor anything.
And this can all lead to withholding problems, right?
That's where I wanted to go. So what is the big reason that you want to stay on the right, the financial incentive to stay on the right side of the IRS is to avoid withholding?
and it's 30% for violations of this chapter of the Internal Revenue Code, Chapter 4. And while it's not a penalty, it is a penalty because it's not recoverable if it's due to the actions of the foreign financial institution. Now, on the other side, on the side of the withholding agents, even if they withhold incorrectly, they get a hold harmless built into the law, and because they are terrified of the U.S. government and their own financial sanctions and so on, which, by the way, are not only financial, because now the new laws, the anti-money laundering and so forth laws, are focused to a much larger extent than ever on the individuals who are responsible for making sure these laws are carried out within an institution. And so they can also be fined, and they can go to jail under certain circumstances.
So obviously, without revealing any names, give us some background on the case that you worked on recently where a financial institution, I think it was in an EGA country, received a payment from a U.S. financial institution, and they withheld 30%.
So EGA 1 countries are exempt. Banks, financial institutions in EGA 1 countries are exempt from the 30% withholding. And they're exempt because their governments have ostensibly taken on the responsibility of supervising these banks. And they've raised their hands and put their hands on a Bible, the right hand or their left hand, depends on what they are, put the other hand on a Bible and said, effectively, we will take care of this. We will supervise these institutions on behalf of our relationship with the United States of America. And that's why we have this intergovernmental agreement. And that reduces the responsibility of our financial institutions from following over 1,000 pages of 8-point type regulations, and and whatever is in our agreement is essentially what they're supposed to follow. That's 30, 40, 50 pages, whatever it is. And so that's the quid pro quo for all of this. Now, so in this case, a qualified intermediary withheld 30% on an institution in an EGA 1 country, and they sent the money to the U.S. government as they're required to. The EGA 1 country bank had no recourse, although it's a very large bank. It had no recourse to the U.S. bank. And so we had to get them their money back. That was what we were retained to do, and we did. Now, the IRS methodology for doing it, and especially during COVID, which just made it worse or enhanced the issues, made it virtually impossible to get the money back. However, there's other systems through the Internal Revenue Code and through our system where we can get money back. So what we had to do was get them a U.S. tax identification number to register with the IRS to get this number, what's called a federal employer's identification number, although they're not a federal employer, but that's what they do. And with that, we were able to file a tax return with the IRS asking for the refund of the income tax withheld, along with all the reasons why. And in less than 3 months, they got their money back, which was, in my mind, somewhat of a miracle given what was going on with the world and the economy. So it is a way of doing it. It can be done. And during COVID, it was much more difficult. They just happened to get into this problem just before COVID. Had they got into it during COVID, we might never have been able to get them their federal employer identification number. And that's important because there's a 3-year statute of limitations to recover the money. So we got them back their $300,000-$400,000, somewhere in that range.
Wow, that's
I
great.
felt like a big bullet was dodged, and I felt very happy about it. And so it's a large international financial institution with branches all over the world. It just wasn't a U.S. financial institution. So yes, that can happen. That does happen.
So that's obviously something that financial institutions want to avoid. And the last thing that we've seen a lot recently is financial institutions who've come to us and said, oh, oops, we have some accounts we failed to report. What do we do now? Well, depends on how long it's been going on, but there's a couple of reasons why the accounts were not reported. And one of them is that the accounts weren't properly identified in the system. They didn't have the fields in the system that allowed them to identify the accounts, particularly if they were older accounts. Another reason is that they had not established triggers to detect when the accounts exceeded thresholds. You have certain thresholds for reporting accounts. And the third reason is that they were improperly using the thresholds. So this is I've encountered this recently on a number of occasions, and I want to clarify something here in terms of what the thresholds are. There were two different types of thresholds established in the regulation. The first threshold involves the pre-existing accounts, the due diligence of pre-existing accounts. And you could basically exclude from due diligence any any account of an individual of less than 50,000 and any account of an entity of less than 250,000. But once you started talking about new accounts, there were no thresholds for entities. And some financial institutions are still using that $250,000 threshold for entity accounts. So if you think that you can not report entities just because their balance is under 250,000, that is a misconception, and we would be happy to help you figure out how to fix that. Anyway, I don't know if you want to add anything to that.
No, I thought that was very well said.
But when we look at what caused all of these issues for the financial institutions, there were some common threads, and among them are the lack of a risk assessment. A lot of financial institutions have not included tax compliance risk factors either at the institutional or at the customer level. So we'll talk a little bit more about that in the final segment of our podcast today. Another one is the lack of a coordinated management commitment. In other words, there was no real tax compliance program. Little bits and pieces of tax compliance. Some was put into AML, some was put into legal and reporting, but there was no FATCA function, no real tax compliance program, which obviously led to a lack of internal controls. And finally, the lack of independent testing of the tax compliance program. We've seen many, many cases where 10 years in, nobody's really ever audited the FATCA compliance. So we want to talk about those strategies now. This is going to be the last part of our chat today. So I don't know, you want to start first, Stanley, talking about the need for a robust management commitment?
Sure. It's no different than anything else in the world of anti-money laundering. And I'm going to start by making a statement which I believe to be true. And that is that FATCA, because of the indicia of deciding who's U.S. and who isn't, became an anti-money laundering statute disguised as a tax statute. Okay. And I think it's important to keep that in mind. The IRS, there's a form called the FBAR, the Report of Foreign Bank Accounts. And that report, which used to be the TDF 9022.1, is now the FinCEN 114. That report is a anti-money laundering report that must be prepared for FinCEN. FinCEN is the major U.S. organization or bureaucratic organization that's in charge of anti-money laundering. It's in simple terms. Well, the IRS was administering that form for years on behalf of FinCEN. Because FinCEN didn't have the manpower, if you will, for doing certain things. It was designed to be more of an electronic watchdog rather than a people-heavy watchdog. It has since become both. But in the meanwhile, it doesn't have any enforcement staff of its own to speak of, or field enforcement staff and investigators. But it has them in very tiny numbers. In the meanwhile, IRS still wanted the form, and FinCEN said, nope, it belongs to us. And they have different philosophies about how to get the information and what reporting people and entities need to do. And so when FATCA was passed by the Congress of the United States, the IRS said, we're going to have our own form, our own FATCA form. And they do. They do. And that FATCA form is a typical IRS form, which is much more complex to fill out than the FBAR for FinCEN, because it only covers, first of all, it only covers individuals and their accounts, or certain companies under certain circumstances with their accounts. But it also requires that you report income in the form and then where it's placed on the tax return. That's duplicate reporting with respect to the FBAR, which was there first. So we have people reporting the same information on two different forms.
So are they required to file both forms?
Yes,
Okay.
but with different trigger points. And that was the other thing. So the IRS came up with its own methodology. So for example, the basic trigger point under FATCA for filing an account, under FinCEN for filing accounts is $10,000 in the aggregate of all the accounts the person has, or the owner of the accounts or controller of the accounts has. All over the world, if it hits $10,000 at any point during a year, you report all the accounts for the whole year, their highest balances. The IRS says no. For us, it's a $50,000 threshold for reporting those accounts on our form, which is very similar to the threshold for the banks reporting individual accounts, right?
Right.
Okay. But these are for individuals who are reporting themselves, it's aggregate for all accounts. For banks, it's it's aggregate for whatever's in their institution. So it's a little different. In any event, that's what they've done. So IRS now has control over supervising the FinCEN account, the FinCEN form, the F-114 or the FinCEN 114 or the FBAR, and its own 8938. And they, believe it or not, they actually compare them. And they use one to look at the other to determine what they want to do. So it's important for the folks out there to understand that if they don't properly report, a couple of things can happen. First of all, they can have a problem with FinCEN. Not them, the U.S. taxpayers can have a problem with FinCEN, because if they're filing their FBAR and they're filing their 8938 and there's a disconnect between what's on the FinCEN 114 and what's on that 8938, it can be an issue for the taxpayer. Or if the taxpayer is reporting more money than the banks are, it could be an issue for the banks on the other side. So IRS does all this. They cruzada them in their system. They compare them, and they come up with what they want. That's why sometimes inquiries come out to banks and they'll be asking them for information, and the banks are like, why are they asking us for this information? Well, it may be that there's a disconnect or a comparison between these various forms, the 8966 from the bank, the 8938 for the FBAR, and the FinCEN 114, and the IRS is saying something doesn't make sense. We're missing something. And so that can create issues for the banks. So we need this management commitment, because without having a strong, responsible officer, and without that officer having at his disposal or her disposal enough funding to properly run this FATCA function, they can end up having anomalous reporting or reporting that isn't accurate, and then that creates risk for the bank. So it's a really important thing, because from there you get into risk assessment. What is an institution's appetite for risk? And we talked about this the other day with respect to the new pillar of risk. A risk assessment is now a pillar, okay, of AML. Well, it applies to FATCA also. It's always been, in my opinion, a pillar. It just was an unstated pillar. So we're talking about incorporating tax risk factors in all of the risk assessments for the institution. And I know you want to talk about the matrix that you've developed, because you're very proud of it, and you should be. So why don't you discuss the matrix that you developed that's similar to the financial institutions manual, the quantity of risk matrix that can be of assistance.
Sure. Thanks, Stanley. So yes, Foodman has developed a risk matrix, and a lot of you are probably familiar with the FFIEC manual that has the quantity of risk matrix, where it has, a list of different risk factors, and then explanation of what types of factors would be low, medium, and high risk. Well, Foodman has attempted to do something similar with tax compliance risk. And so we've developed this risk matrix that covers things like, for example, conflicts between the FATCA regulation and local regulations, different types of risks that come from the customer base, including what types of products and services the customer uses, what types of aggregate balances the customer maintains, also jurisdictional risks. So using this risk assessment can help an institution identify the areas of higher risk and make sure that they have the ability, both at the institutional level and at the individual client level, to flag activities and or customers that may present a higher risk in any of those categories. And I can tell you that when I talk with chief compliance officers and general managers and even board members about their general regulatory compliance, when you say risk appetite, they always say they have zero appetite for regulatory risk. Well, that sounds really good in theory, but then you have to stop doing business because there will always be some regulatory risk. So if you want to have a very low appetite for risk, you got to make sure you understand what your risks are. So identifying those risks and making sure that you have correctly seen where the risks are in your institution, it's the only way really to develop the compliance program that's effective.
Yeah, and the AML, the anti-money laundering law of 2020 actually has an effect on this, doesn't it? Because of the look-through that's allowed to the U.S. government when it wants information going through right from one institution in the U.S. straight through to one of its account holders, which are other banks, right? To get information. There is an implication. It hasn't happened, but it's there.
Well, I tried to find out. I did some research to see if there had been any subpoenas yet issued
Not
under
yet,
new
not yet.
but it's almost as if they don't need to because that's their backstop. There were other ways to get the information. So I think that since foreign governments know and financial institutions know that's there, they're able to use existing bilateral agreements or tax, legal compliance agreements to get information.
Which is what I discussed in the beginning of this with respect to a client who was in another country, happened to be Panama, and how they use the local
Right.
anti-money laundering rules under Financial Action Task Force to get to an IRS result that they were looking for. And
Correct.
so they're very clever. They are in our government. They are not uneducated. They're very well educated about this. They're very clever. They're what we would call zorros, right? And they're very good at getting what they want. And of course, they wield the U.S. government's economic power ruthlessly to do it in many cases.
Right.
So look, conflict between FATCA regulation and local regulations are always a question. It's not just FATCA, it's other regulatory issues and how the FFIs resolve them. And we always recommend that people talk to they have questions that we feel are better answered by local counsel. We recommend it because there may be some real risks involved or real conflicts between local rules and FATCA that have to be resolved for these institutions. Jurisdictional risks are something else. Who are you doing business with? Where are they located? Where's the money coming from? Where's it going to?
Right. So jurisdictional risks, not only where the financial institution operates, where the customers come from, and where the transactions go. Those are all things that need to be taken into account.
Exactly. And then customer due diligence. So CDD is a broader term than people realize, in my opinion. I think that it's in the world of general regulatory compliance, CDD goes beyond the four corners or the four walls of a particular entity or institution in dealing with its customers. In many cases, they're going to have to figure out who their customers are doing business with or understand it because it can have an effect on their own FATCA status. So, and then, of course, how is FATCA information captured in EGA and not in non-EGA jurisdictions?
Because there are slight differences. Under EGA, for example, the the customer due diligence for entities is less rigorous than it is in a non-EGA country. So understanding how you get that information is important.
And why is that so? It's so because we decided as a government, the United States, the IRS did, to give a little bit of a carrot, if you will, to the foreign governments in exchange, or for their banks on behalf of their banks, in exchange for them supervising these institutions. And how does a bank's platform allow for proper identification of FATCA indicia? I mean, how are they doing that?
Especially when they're opening accounts online, how do they make sure they've asked the right
Right.
questions to ensure that
And
that
not
they're
just the
able to
right
identify
questions,
them?
but is there any responsibility in the answers that the bank needs to take into consideration for itself, its own responsibility when it's getting answers, when it's receiving answers, or is the bank simply able to just accept whatever they're told?
Well, I mean, the FATCA regulation is fairly clear that banks are allowed to accept a self-certification, provided that they do not know or have reason to know that the information is false. So you
And
can't
why would they have a reason
override.
to know? Why would they have a reason to know?
Well, I'll give you one example I saw in a real life case. A customer
Good.
had filled out the onboarding information and had written down their place of birth as Miami. That was when they opened the account in 2013. When the account was was redocumented in 2014 after FATCA came out, suddenly the place of birth was no longer Miami. It was, I don't remember, Medellin or something like that. That should be a reason to know, or at least require an explanation. So those types of things, you can't just accept what that you, even in an EGA country, you're required to validate the information based on other information you have collected due to
Right.
your customer due diligence.
And we see that it's not only applies to this, it applies to other things in the regulatory vein. We call that not being able to use willful blindness.
Exactly.
And some of it can be culturally dictated. I have seen cases where customers came to banks and said, listen, or came to onboarding people in the banks, the people that front for the public facing people, and said, please, we don't want you to report on us because our grandparents knew each other and we've been friends all of our lives. And can you do me a favor? And maybe that's okay culturally, but in protecting the bank or the institution, it's just not really okay. If the bank, but once again, we're back to risk appetite or the practical functioning of risk appetite, in an institution. And
Correct.
then how do you cure indicia of U.S. roots? How do you cure that of
And
U.S.
how do you
citizenship?
document it? How do you ensure that, yeah, and how do you detect changes of circumstance? So all of those things are very important. And this is kind of leading up to a little bit of a crescendo at the end, because what we want to end up with is the idea that almost everything we're talking about here would have been detected with proper independent testing. So our kind of final takeaway here, I want to just talk quickly about internal controls and training, but I don't want to leave. I want to make sure I leave enough time to talk about the importance of independent testing.
Of course.
So, having internal controls, making sure that they are detecting changes in circumstances, detecting balance increases or decreases that impact the application of thresholds, identifying customers with repeat transfers to the same account in the US. Remember that one of the FATCA indicia is standing instructions to transfer money to an account in the US. If you don't have an ability to detect that, you're going to miss some of that. Validating the GINs of financial institutions so that if they lose their GIN, you find out about it before, there's a withholding issue. And then making sure individuals have been tasked with monitoring the IRS portal.
Okay.
And then just briefly talking about training. All staff needs tax compliance training. It's not just frontline. It's not just compliance. It's not just legal. Everyone at onboarding needs to have an understanding of what the institution's tax compliance requirements are. And there's needs to be training by different job type, different training for frontline, for tellers, for operations, for risk management, compliance. And yes, the board of directors needs to understand the importance of tax compliance, because again, they're the ones with the purse strings who are going to provide the resources for the tax compliance program. So Stanley, I'm going to bat this one back to you to talk a little bit about the importance of independent testing and the Foodman audit plan.
Thank you. I'm a big believer in independent testing and for many reasons, not the least of which is as an internal audit device. or a device for bolstering or helping with the internal audit and internal controls function. So it's important to ensure that there's periodic independent testing. You can have an audit. It's not required under the IGA or direct participation. It's just not. But the responsible officer of a company needs to establish a compliance program, and it's sufficient to ensure compliance with regulations and is required to conduct a review of the program. So what is so we're back to what is the word? What is a review? What does that constitute? And I think it's important to keep in mind that from our perspective, it's a conflict of interest to review your own work, for one to review their own work. In a firm like ours, certain types of work we have levels of review. And it's important to maintain that because anybody at any time can make a mistake. It just happens. It's human. Even AIs make mistakes. We know of a lot of cases where AIs were used for different things and they made mistakes, partly because of the construction of questions and partly because of the age of data being reviewed or being looked at in order to determine certain rules and things. So a review minimally, if it's going to be done, and it's supposed to be done, should be conducted prior to each periodic certification of compliance, minimally. We like to see it being done. We think certain reviews should be done annually. Certain reviews by an institution should be done quarterly. Reviews at a different level internally, monthly. It depends on the nature of the review, but reviews are very important. So what we've done is we developed an audit guide to assist financial institutions, internal auditors, to review and test their programs for FATCA. We think that it's something that should be done. It's very similar to what you would see if you were looking at a regular outside financial statement audit program, except the terminology and the requirements are different because it's a different process that we're going through for a different reason. And what it'll allow us to do is better identify changes in circumstances, and it will allow for the enhancing of existing controls to identify tax risks. It becomes a training tool. From the results. Training can be enhanced by job type. There's a lot of uses for these things. And of course, the board of directors can then be continually brought up to date from the use of these risk assessments, so they can see what the risks are for themselves as well as the institution, because there are risk factors relating to directors of these banks also.
Yeah, so the audit guide is a program that we offer under license for institutions who are interested in it. And it really, as Stanley said, is a step-by-step guide for internal auditors in conducting a review of the program. And again, like we've said, we've seen in the last couple of years where even though FATCA is 13 years old now, 14 years old, there's still a lot of misunderstanding and there's still a lack of review. And I think, we feel that this is a good opportunity to, we offered this before, we've updated it. It's now available, and you will all be receiving some information about it in the follow-up email to this webinar. But we think it's very important to establish an independent testing of your tax compliance and ensure that it really covers the different areas, especially if, as I mentioned earlier, your management wants zero risk, then independent testing is an extremely important part of any compliance program.
Agreed. FATCA, you mentioned the number of years. So FATCA was signed into law in March of 2010 during the Obama administration. And then for 4 years, because the IRS's budget didn't permit them to really get on top of it, it sort of wasn't put into what you would call put into vigencia or full use until 2014. It's still not 100% in use, but it is almost 100%. There are things that they still allow banks to not do that they want them to do, and they keep on temporarily extending the deadlines. But starting in the first year that a FATCA report was required was in the year 2011. And that was and I'm talking about for US taxpayers. They had to file their own. The banks were already supposed to be playing with or working at producing the 8966, but the actual full-blown FATCA program of the IRS came into being in 2014. So it is a long time. It's at least 11 years, and they're getting better at it. Remember that it was designed to be an IT-driven program. It has turned out to be more people-heavy than they wanted it to be, because it's a program which is written in U.S. tax code for people who have never dealt with the U.S. tax code. And so there's a learning curve, and it's quite steep. It's quite steep, and so it requires constant reinforcement.
So I think we've reached the end of our presentation. Again, we thank you all for being with us. You'll be receiving a follow-up email, which will include a certificate of attendance and also information about the audit plan. But we're certainly interested in hearing from you. If anybody has any questions about anything we've talked about today, please reach out to us, and wishing everyone a good day. Any last words, Stanley?
No, I just think that FATCA has been undervalued at a certain level, and I'm prejudiced about it because I'm a CPA and I deal with tax matters, but I can see but I know why it was developed, and I know why it was, and why it's been undervalued, I believe. And there's been resistance to it, and an undervaluing in part because, and I'm very sympathetic to this, we have imposed our will on countries outside the United States, and we've tried to change the local cultures. And it's met with a certain amount of maybe even unconscious or subconscious resistance, not intentional. But I think that given the administration we have, if they decide they want this imposed more stringently, the current president is not necessarily given to subtleties, and it could become a much more overbearing situation than it is today if they decide they want to make it that way.
Indeed.
Anyway,
thank you everyone for attending.
Thank everybody, and you have a wonderful day. And I'm looking forward to seeing everybody, or at least you seeing us in the near future.
Exactly. Oh yes, at FIBA we'll all be at the conference.
Yes, let us know if you're coming to the conference. Send us an email.
Yes, we'd love to meet you there.
Yes, absolutely. We're going to have a nice booth, and we can all have a cup of coffee or maybe a pastry. Thank you. Bye-bye.
Bye.